Hey guys, TommyBryson here, and far it be it from me to make a video trashing index funds because this is not what this video actually is. But it is a warning for everyone that actually wants to invest into index funds or is invested into index funds and basically thinks that index funds are so big, so massive, they're just the best investment vehicle out there, and there is never going to be any risk whatsoever when it comes to losing your money, okay? That's not true. Now, I have literally all of my money that's for investing into index funds. It's the only asset that I basically own that produces for me the majority of my investment income, okay? So I am sold on index funds, but I'm also sold on the big problems and risks and issues in the future that can come from just investing into index funds. And that's why I stopped investing into index funds. I stopped reinvesting my dividends. And now I'm going to be doing something else with the money I'm not investing into index funds. I'll tell you more about that at the end of the video. And by the way, index funds are a massive industry. I think Vanguard has over $5 trillion in assets, and then BlackRock has over $4 trillion. It's big, it's massive. But when it comes to investing, you should not be making your investments just on size and popularity because everyone else is doing it. But you should be making your investments based on the actual asset itself and what the risks actually are when it comes to your capital. So do me a favor and like this video and let's get right into it. Now, the very first thing I want to talk about is basically the idea that index funds are too big to fail. I just mentioned, okay, Vanguard has over $5 trillion, BlackRock over $4 trillion. And when I say the word trillion, I just say it. But there is no way in my head I can imagine that much money. It's a lot of money. I can barely imagine what $1 billion looks like, okay? It's a lot of money. But overall, there is nothing, no business, no country that is basically too big to fail. We had that whole mindset during the 2008 thing with the whole housing crash market, and we thought it was too big to fail. But actually saving those banks could have basically sent the country into like a whirlwind if we did not take the action we actually took. But picture this, okay? It used to be that basically these days, if you go to a bank, there is no real worry about you losing your money or the bank going bankrupt because you know it's FDIC insured up to $250,000. But back in the day, everyone had a fear that, hey, banks do lose money, banks do go broke, and I could lose all the capital I have in a bank. So there is a risk. And I want you guys to know that although the risk is tiny, the percentage is on the low end, well, you can still experience that low end of risk, and you have to be aware of that. For example, okay, the way I picture myself losing money when it comes to index funds is usually a war or something crazy happens, okay? Imagine a big war and we barely win. And in order to barely win, we basically had to increase production, increase spending, increase the printing of money, and just basically take the nation full on, all right? And we barely actually won the war. Now, what are we actually left with? We might be left with a country that is basically experiencing hyperinflation and a lot of issues, okay? So guess what happens? You could be sitting on an index fund that's not going to make money for decades to come, okay? On top of that, you could experience a place where we don't win the war and you lose all your money, okay? That's also a possibility. Or we go under a new regime and you lose all your money. That is also a possibility. Now, the odds of that actually happening are slim. And the odds of that happening and you caring about your money is also slim. But it's important you know, nothing is too big to fail. Now, number two, guys, is going to be no risk investment. There is no investment that carries no risk. However, the risk of you losing your money with index funds is pretty low. I had to mention literally a whole catastrophe for you to basically say, hey, well, I could lose all my money if that happens. But the risk is pretty low, okay? But it does not mean there is not risk. So the real risk for me when it comes to index fund investing is not the losing of one's capital in totality, but it's actually the time and waiting to recover what you once had. Let me explain, okay? So we had, for example, the Great Depression, and I think it took the market about like almost 30 years or 25 years to actually go back to what it once was. Now, I want you to imagine that, okay? Imagine we go into a downfall, all right? A down market, and things get pretty bad, and you had $100,000. Now you only have, for example, 10,000 or 20,000 or 30,000 or maybe even 40,000, meaning you lost a bunch of money, okay? But you haven't realized it. You haven't sold, so you haven't really lost anything. All you have to do is wait. However, if I sat you outside of my house and I told you, just wait, I'll be out soon, and I don't tell you the time, I don't tell you when, I don't tell you the year, you would probably get impatient. When 10 minutes pass, you're like, when is Tommy coming out? 20 minutes, this guy's, when is he come? A day, you're like, I'm leaving. Well, you don't have to wait a whole day, but you get my point, right? With stocks and recovery in markets, you don't really know when it's going to recover. Everyone has an opinion. The media will give you an opinion. People on YouTube will give you an opinion. The government will give you an opinion, but no one really knows, okay? So imagine you waiting 10 years, 15 years, 30 years to actually see your money come back to what it once was, okay? That is likely. That is a probability, okay? So you have to understand that there is that risk of you having to wait a long time. And you might say, I can wait, no big deal, right? No big deal. Thing is, hindsight is 2020. So when we look back at those days and you're like, well, the market always recovers, yes, but you've never been 50 years old and had to wait 30 years to get your money back and basically not have any money during retirement, okay? That can be a real thing. That's why you don't just want to rely on investments, as far as, for example, index funds, to take care of you as a whole. More on that later, okay? The third thing I want to talk about here is going to be set it and forget it. Truth is, there is no investment that's going to be set it and forget it, okay? People that invest that way usually never know what's going to happen. Now, if you get lucky, right, and everything goes as it has gone in the past, you'll be just fine. But for the most part, index funds might not always be the most attractive investments, okay? If you're setting it and forgetting it and you're not looking into anything else at any time or looking at your returns, you might be stuck and you might basically miss opportunities. For example, if bond rates go up to like around 10% or 8% and you're like, I'm just gonna set it and forget it, okay? No big deal. I'm just gonna keep investing into index funds. No, I would say, hey, I'm taking my money out and I'm gonna put it into bonds. It's like basically risk-free returns for the most I can possibly get, okay? Or if something big is happening that can basically mean I'm not gonna get my money for a long time and I need that money for something, then I could also consider that, okay? The point is, you never wanna set things and just forget things, okay? You have to be aware of your environment, have to be aware of your investments, and know exactly how things are actually going. If you're 70 years old, for example, you don't want to set your index funds and forget them. You might say, I have $1 million, $2 million. I'd rather use that money and basically put it in a bond or in a CD and live off of that and not have to worry about a massive decline. Because the goal at that point is not to multiply your money, but basically to preserve it and to live off the eggs that that money makes you. If you're 40 years old and you have $1 million, you work so hard and you're like, I'm gonna set it and forget it. No, you could possibly keep half the money in there, take the other half, buy 2 properties or 3 properties, and then get rental income and then supplement also your investment income and basically not have to work anymore. So you never just wanna set and forget things. You want to basically always be analyzing and thinking things through. Now, index funds are almost like a set it and forget it investment, meaning they're very low maintenance, but that doesn't mean they are zero maintenance. You have to be on top of your things, okay? That's the idea. Now, the last thing, guys, is going to be low profits mean more money invested. Over the years, the index fund has made around the S&P 500 has made around like 10.53% or something like that. And when you actually go back even further historically and you accumulate that, it's more like around like 8% to 9% or something like that, okay? It's not a sexy number. It's not an attractive number. It's not a number that you invest today and tomorrow you're wealthy. It's not that at all. It's gonna take time to actually get that to actually happen, okay? That's how it kind of works, right? time with these investments. And by the way, I have no problem with waiting. I'm not impatient. I can let my investment basically compound, but you have to know something, right? As more people keep investing into index funds and less people stop caring about the prices that they're actually buying investments at, because right now, I think the PE ratio of the S&P 500 is like 24 or 25, basically saying that through earnings, it's going to take like around like 20 years to get that price back or that money back in a sense, okay? So the whole idea is, as more, it's like, you guys remember like the housing crash where people were basically just buying houses with borrowed money and no one cared about the price, and so prices kept going up and up and up and up. At a certain point, you get less money back, okay? Because it's not like the returns are going to keep going up and up and up and up. It's just the price is going to keep going up, okay? It's like if you buy a plot of land for $1 billion and it can only produce $10, it's not like if you paid 20 billion now, it's going to produce more than $10. It's still going to produce the same $10. That's basically maximum capacity of earnings for that land. That's the idea. So your returns get lower and lower and lower. So eventually, index funds might not be that attractive, and you might have to consider, for example, other investment avenues and vehicles. So what's my plan right now? What exactly am I doing, okay? First of all, I love index funds. They're a great investment, but you have to know they're not a risk-free investment, they're not a set-it-and-forget-it investment, and they're not an investment that is always going to be the best and most attractive investment ever. Although, they want to sell it to you like that, okay? Because why not? But the idea is, right now, I stopped investing money into index funds. I stopped reinvesting my dividends, and I basically use that money to save up, use the dividends to save up, and I'm using those savings to buy some real estate. Why? Because I need cash flow, okay? So if I have enough money right now in the stock market, but tomorrow it crashes by 50%, what am I doing then, okay? Gotta go back to work. So if I have enough money in the stock market, but I also have some real estate that's basically paying me some rents, then I can be, for example, more independent in a sense, okay? So that's the idea. I'm not stopping investing to live off that money. I'm not stopping reinvesting my dividends to live off that money. I'm doing that to reinvest into another investment to produce for me more cash flow. And that cash flow, I'll probably use it to buy more investments, okay? Because I make enough income to actually live a pretty comfortable life. And if I can build a bigger cushion, then I can be pretty better overall, okay? And there are things to think about for the future, like raising kids and so on, okay? So it's very important to think about your life as a whole and not just your life, you being 60 years old and so on. It's very interesting stuff, okay? But that's another video for the day. But that's the whole goal here, to show you that index fund investing is not a set it and forget it. Thanks for watching. See you guys next time. Peace. Subscribe to the channel, by the way, if you like this content.